Should I invest in my own backyard? I don't know. I did when I got started, but since then we've grown dramatically, and so has technology. And we've built a nationwide real estate acquisition company. We've proven systems. These are the proven systems that I'm sharing with you. We've built dynamite teams. So with those things, we can acquire anywhere. But just because we can acquire anywhere doesn't mean we should. So how is it that we know which market to buy in? Well, I've got some a quick way of looking at this, but the reality of it is how many of you are actually going to analyze these markets? These are the ways that we do it. If you have more questions, I'm going to get right to the point on this. Please schedule a help call, send an email, drop a comment below. I've done a lot of research on this, written about it in the book. Lots of stuff. So let's get to it. Again, not to put you to sleep, but to see there's purpose behind the process. All right, so there's five major things that we look at here in order to get there. It's gross metro product, MSA population, the housing affordability index, the price to rent ratio, and then the economy. What are the jobs? Most importantly, it's an outside in approach, which means I'm going to find the market and then I'm going to find the house. I'm not going to find the house and then see if the market's good, right? So all the way out, zoomed all the way out, the first thing we're going to do is look for landlord friendly states with short eviction timelines. And, unfortunately or fortunately, whatever it is, politics make a huge difference when it comes to real estate investing. So it is likely that red states will have more landlord-friendly laws than blue states. Blue states tend to lean more tenant-friendly laws. So outside in, boom, that narrows it down to states. And for me, I want to make sure that we are in MSAs with populations greater than 1 million with a steady increase year over year. And if it's increasing 2%, 3% year over year, that shows that it's growing. There's so much that a larger area offers us in resources. There's going to be more deals, more opportunities, more contractors, more renters, more jobs. So we like those bigger areas. High gross metro product with steady increase year over year. Again, looking at that 2 to 3% increase year over year. Look for major manufacturers, healthcare providers, tech companies, finance companies, and Fortune 500 companies. Typically, that type of information is easy to find. Population, you can literally Google search, let's see, what is the population of city name, MSA, and it shows you, most of the time it'll show you the increase over the past 3 years as well too. So really easy to find those things. Gross metro product is a little more difficult to find. Let's see. Gross metro product is basically the net of the economy, right? And I'm gonna make this really simple. So you've got what you're exporting and what you're importing. So if a area is producing more, selling more than what it's bringing in, then that area is good, right? That area will have a positive gross metro product. Affordability matters. That's why we looked at these two numbers here: housing affordability index and price to rent ratio. Affordability matters, and I wrote about in the book about saying, okay, buy me. Would you rather? Kids play this all the time. Would you rather buy a rental in San Francisco or San Diego, or would you rather buy one in Memphis, Tennessee? Well, there's some things that we need to know. What's the return? How much capital? But it's very likely that it's going to cost a lot more to get that $200 net return in San Diego than it is in Memphis, guaranteed, right? So affordability matters, and these are the numbers that we use to get there. Housing affordability index, median home price divided by median annual income. How much does a house cost? How much does a normal person make? Median person, average person make there, right? So without getting into the math of it, we usually target markets with the housing affordability index of less than 6, preferred less than 4. It means the smaller that number gets, the more affordable that market is. Meaning the more return, the more power for your punch you're going to have with your capital. Price to rent ratio is annual median rent divided by median home price. So what is the rent and then what's the value of the home. And we are targeting markets with less than 15%. And I've watched some of our markets, creep up on this particular number here in the last 5 years. One of them, which is Jacksonville. Jacksonville, for us, basically shot out of range in the last 5 years because of growth there and appreciation. So two numbers, just basically we want affordable as an investment, and we want it affordable for our renters as well too. Data caution, always put this out there. You will find exactly what you're looking for. Don't rely on data provided by someone else, always verify. But if I like this market and I go out, I'm going to find reasons why this market works. So be careful, you will find exactly what you're looking for. You need to be objective, not subjective, right? Affordability caution, you get what you pay for. And I talked about that briefly just a little bit ago about the the rent ratio. That's what I was talking about. So when you get a rent ratio that jumps way up above that 1.5, in the 1% rule, 1.5 to above, you're going to get what you pay for. Typically, that's a really bad house, really bad area, really bad tenants. In my experience, I've got one that performs at 2.7, one of my first ones. And it was infinite return. Love it. I love the house. We fixed it up. I bought it for $18,000. I bought the house for $18,000. I put $15,000, renovated the house, put $15,000 into the inside of the house. And so I'm sitting in it for $33,000, and I think we're at $950 a month on this house. So great return. I can control the house. I can control tenant with screening and the property management. I cannot control the neighbors. I cannot control the neighbors behind. I cannot control the road. That's the tough part. If you get a slumlord living next to you or owning next to you on either side, or there's drug dealers, crackheads, all of that stuff that happens in these types of areas. Affordability matters, but you're going to get what you pay for. So just be careful. After selecting the city, you need to understand zip codes and neighborhoods. Build your preferred zip code spreadsheet. Utilize Google Maps Street Views to walk the neighborhoods. So what we're doing is we're going outside in. We've got blue states. We've got, let me put it this way, landlord friendly states. And then, then we get their states. Now we get our MSAs. And inside the MSAs, now we need to make sure that we know the zips or the neighborhoods inside of there. So again, where you can lean on your team, lean on your team real estate agent, your property managers to give you that feedback. And when you build your zip code, your preferred zip code list, it's a lot easier to see if a deal works, or even where you're looking off of that list. If you're researching and you jump down, I have, through the years, my acquisition team will present me deals, and as soon as I jump down on Google View and I see a house boarded up next to it and pit bulls chained up on this side and a party happening over here, it's like, that's not good, right? So the blighted properties, boarded up stuff, you get down on Google View, they're pretty updated with most of their pictures. You can get a feel of that neighborhood. One of the things you can't see, though, is blocks are different, right? So in this place that I'm sitting here, when we flew in one day we walked a couple properties, we put the offer in, we got it. Well, when we came in this property, we came in from the back way here, which is through a very, very, very nice neighborhood. This is the end of that neighborhood, and as you go one block back that way, it's still a nice neighborhood, but it's just not the same as that one over there. So each block is different. Same way, when we're in rental properties and we're in the $100,000 to $150,000 price range, a block can make a major difference between going from C plus to F to A. Like, blocks make a difference. Rely on your boots on the ground to make that difference. Generate your buy box or buy window that identifies what specific types of houses you will be the best to find, insure, mortgage, and rent. So for us, we know, based on the particular market, we know exactly what fits our buying criteria. Bedrooms, bathrooms, square footage, year built is really important. And we do these particular things because we know we can get the rent for them. We know that the insurance company will insure them. We know that the mortgage provider will lend on them as well too, and ultimately that the renter will pay rent for that. So if in your investment criteria you say, oh, I want to do duplexes, okay, great, but then you go into a market like, I don't know, like Memphis, Tennessee, it's not likely you're going to see a lot of duplexes there. Where if you're in Grand Rapids, Michigan, you're going to see lots of duplexes there. So it's just market based. Your buy boxes are market based. But go ahead, you got your zip code list and your buy box, and I'm making this so much easier to filter out properties or opportunities before I even have to think about running an analysis on them. Create your list of automatic disqualifiers as well too. So I've got the zips that I want. So I got my state, city, zips. I got my buy window, what types of properties, specifications, bedrooms, bathrooms, square footage, all of that stuff. And now I want a list of things that I don't want. And these things can be, let's see, I've got a list of them. We don't do condos, we don't do prefabbed or manufactured houses. No commercial or mixed use. We don't have to have golf club membership requirements. We don't want a house with any of those. No age restricted communities. No structural or environmental hazards. We don't do pools on our long terms. No dirt driveways. Septic and well, we may have to make sure we have an inspection done on that. No fire damage. We don't purchase adjacent to commercial structures. We don't purchase adjacent to school buildings. We don't purchase located on or adjacent to 4-lane roads. We don't purchase adjacent to high voltage power lines, and we don't purchase concrete masonry unit houses, block houses as well too. Lots of reasons why we don't do these things. And again, it comes back down to being insurable, lendable, highest market rent, and ultimately if you're building these portfolios to flip to bigger hedges, these are hedge requirements. So what we do is we do similar to what the big hedge companies are doing. We're doing the same thing. So I want you to go from the outside in approach. Again, 80-20, get there. If you have more questions, drop a comment, schedule a help session, and we'll get you run through this. But this is exactly how we look at markets.